Welcome, everyone. I'm Ceyla Pazarbasioglu, Vice President for Equitable Growth, Finance and Institutions at the World Bank. Today, I'm joined by Martin Wolf, Chief Economics Commentator at the Financial Times. Very good to see you, Martin. Martin needs no introduction since he is an award-winning columnist and author of several books. His most recent publication is The Shifts and the Shocks: What We've Learned and Have Still to Learn from the Financial Crisis. We're going to discuss today what we have learned and have still to learn, which is a lot, from the COVID-19 crisis. And of course, we are still in the shadows of the global financial crisis and the trade uncertainties, which were already there pre-COVID. We have a global audience. I encourage you to join in with your questions online, and we will answer them towards the end of the session. So let me start with some key headlines on the impact of COVID-19 crisis from our Global Economics Prospects report. We published the GEP last month, and we started by saying that the global economy is going through its deepest recession since the Second World War. More than 90% of countries will face per capita income losses, and this is a larger fraction than in any recession in the past 150 years. The crisis could push 70 to 100 million people into extreme poverty, causing the global poverty rate to rise for the first time since 1998. And like previous recessions, and probably more so, the current one is likely to leave lasting scars on the global economy and especially on developing countries. These scars could come through multiple channels, including lower investment and innovation, erosion of the human capital of the unemployed, and a retreat from global trade and supply linkages. The result will likely be a lower potential growth, investment, and labor productivity. The COVID-19 crisis has also come at a time of large buildup of sovereign debt. We already warned about this back in December, that we were at the crest of a wave of rapid global debt buildup after 2010. This was the fourth such wave in 50 years. And by now, this is looking more like a tsunami. Previous waves of rapid and broad-based debt accumulation have all ended with financial crises in many economies, and this often resulted in substantial and long-lasting output losses. So most emerging and developing economies started the crisis far less prepared, with high vulnerabilities like weak health systems and record levels of sovereign and corporate debt. They have been hit by a great shock, and this was compounded by spillovers, economic spillovers from advanced economies, China, and so on. And they have a very constrained policy space to respond. So this makes it likely that this could be a sharp and protracted decline in potential growth. So the bottom line is, as you said recently, Martin, we are going through a colossal storm. We will make it, but it is not clear in what shape different countries will emerge from this, especially those that started already in a very fragile state. You started your career at the World Bank, Martin. We have been at the bank working really around the clock. World Bank Group resources are being scaled up dramatically to support countries to overcome the pandemic. We recently reached a milestone few weeks back by quickly implementing programs in over 100 developing countries. And together with the IMF, we called for debt service suspension for the poorest countries so that they can really focus on managing the storm. You follow emerging markets and developing economies. It would be great to hear your thoughts, what the countries can do during the relief phase, because this will have implications for the future, for the recovery and building phase. So any lessons from history, what you think would be the key priorities, would be great to hear from you. Over to you.
So first of all, Ceyla, it's a great honor and pleasure to be in this discussion. And I'm looking forward to our conversation. So I was thinking a little bit about this question. And it reminded me, I was in the World Bank, it's almost unimaginable, really, between 1971 and 1981. So it was a very, very long time ago. This was, of course, McNamara's bank. The bank was the core of development finance. I mean, it was the intermediary. There was very little private sector finance. So a lot of the discussion we're having now would have been inconceivable. But one of the things I remember very vividly is the oil shock, because I was working on East Africa during the first oil shock. And what's interesting about it was the first big global macroeconomic shock that occurred really after the Second World War. So it was a tremendous surprise, a bit like this. And we were terrified. What would happen with the oil price quadrupling? I mean, it was a crisis for many developing countries. Subsequently, I worked on India, which was very badly hit. And there are many lessons from that crisis, but the most important, I was suddenly thinking about this, is we decided as an institution, but not just us, but we were very important, that one of the ways to keep the world economy going was to do what was called recycling of the surpluses of oil exporting countries. They were making suddenly huge surpluses because the oil price had quadrupled. And this money was recycled through the euro-dollar market to developing countries. And 7 years later, it led to the debt crisis. So one of the lessons, I think, very important lesson, is think about the longer run consequences of what you're doing. We thought this was a very good way to keep global demand up, but actually it led to a monstrous crisis and lost development in many countries. Sorry, we just go. So that means that we have to think not only about what we are now, but where we're going in future. You have to play a longer game, not just think about the immediate. And that's really complicated because this is unpredictable. We've never had a pandemic operate on the world economy like this. The last time was more than 100 years ago when we didn't close down economies. It's completely new, but we have to think about the long game. Just to focus on the immediate, in the core countries, the big economies of the world, China and the major developed countries, we have to keep demand going. It's crucial that we sustain demand. I think that's largely understood as best we can, given, of course, the closures. We had to stabilize financial markets. Looking back on the 30s, that was done. That's very, very important. We have to keep trade open. This is a bigger worry because if you look back on what happened in the 1930s, protectionism made it much worse. We had the financial crisis and then the protectionism. So that means inward-looking populism, inward-looking protectionism is very, very dangerous. And the final pretty obvious lesson from previous crises is preserve international peace. Because after all, the 1930s, which was the biggest recession before this, ended up with world wars. So there are some absolutely core lessons. This is not just an economic crisis. Geopolitics also matter a great deal. In terms of the emerging markets, well, I think they have an incredibly difficult problem with managing the disease because I don't think it's viable for most developing countries just to close their economies down. They don't have the resources to support the huge number of people in the informal sector without work. They must do what they can. They must support the vulnerable as much as they can. But some of the options available in developed countries aren't really available. They obviously have to put what resources they can into health systems. They have to be supported. They should use macroeconomic tools if possible. I'm very happy they're using quantitative easing. They're allowing QE in some cases, as I said. They're allowing exchange rates to float. I think that's very important. I think it's very important to sustain investment if they possibly can, because otherwise future growth will be even more curtailed. And of course, it's crucial to find some way of getting debt service in the medium term down. So those seem to me the immediate priorities. But as I said at the beginning, I think a crucial question is where will we be 2 or 3 years from now? We shouldn't ignore that. I think that's part of, you address that in the global economic process. It's very important not to treat this just as the next 6 months problem.
Yeah, fully agree. But also what you do now will have implications in 2, 3 years down the road. And what I find the most difficult in this crisis is that usually when you are managing a crisis, you inherit a mess. You know, you can diagnose, you can agree on a strategy. You know, you can rebuild your strategy as you get more information. But you have a sense of what is viable, what is not viable, and you can target your interventions. In this crisis, it's very difficult to know how we are going to emerge out of this, which sectors will be most impacted, and you have talked about this before. What will be the role of technology? So it's especially when you have very limited fiscal space, how do you prioritize your actions so that you can build a better recovery? I think this is the biggest question that we have been grappling with and working with many of the countries that we serve, that we partner with, and really also looking at building or making sure that the mechanisms are there. And if we are thinking about the immediate, couple of years, that one can deal with insolvencies, have out-of-court settlement systems and things like that, which can hopefully help. But you're right, it is very important to have an eye on what is ahead of us, even though that's very difficult to judge. I don't think 6 months ago any one of us would have predicted what we are going through now. But I agree with you, it's really very important. One issue I wanted to ask you about today, it's of course revealed the recovery fund in Europe. This is for the reconstruction of Europe after COVID-19. Of course, it also brings to mind the Marshall Plan after the World War II. What do you think what are ways for emerging markets and developing which have much more limited fiscal space and need resources, public sector and private sector resources, to help them as they reconstruct?
Well, I think one of the key issues you've already indicated, and one of the key worries, is that the world as a whole, particularly the developed countries, have not responded with the generosity that is needed. I think I'm going to have to get a glass of water. I really apologize. I'll be right back in a second.
That's fine. I will mention a little bit the initiative that we have called for as we wait for Martin. The IMF and the World Bank, David Malpass and Kristalina Georgieva, called for the debt service suspension initiative. This was back in March. This was endorsed by the G20 and the Development Committee of the Bank and the Fund in April. And we have in place a debt service suspension initiative, which helps the poorest IDA countries to really focus their attention on addressing the crisis, both the health and economic impacts, and gives them the relief in terms of debt service obligations. And the numbers are large. It ranges between 0.5% of GDP to 1% of GDP, which they can really focus on. It's a limited time between now and end of the year. There was a discussion last weekend at the G20, and there is going to be there were calls for potential extension of this debt service suspension, and there will be a discussion, of course, during the annual meeting. So that's one way the international community has come together to support the poorer countries. But you were mentioning that there could be more efforts.
Well, first of all, as you know, there's a big problem with commercial debt, which of course has become a very big part of the funding of many private sector and public sectors in emerging economies. That's of course new. That actually started with recycling. And as you've also pointed out, that often ends up with debt crises. So we're there now. I have some thoughts on that, but that's a big problem. We have been pushing hard for additional resources. I think a large new allocation of SDRs would have been very appropriate. We argued, along with others, that those countries that received SDRs, which were surplus to requirement, should give them away or lend them on very, very generous terms to emerging and developing countries. We could have talked about $1 trillion or more. That would have made a big difference to emerging and developing countries. I think in the short run, these financial means were crucial, and a lot of that clearly had to come from the official sector. Unfortunately, we don't, again, have a sovereign debt restructuring mechanism. I think if we had, we could have used this as an opportunity to impose a standstill across the board on debt service throughout the crisis. So there would have been a special circumstance for this. And I think even compared with what happened in the financial crisis, back when there was again also a big increase in resources for the IFIs, as well as an SDR issuance. I think there was a capital increase for the World Bank. There was a big increase for the IMF. The first G20 meetings in 2008 and 2009 was seminal, looking at regulation, looking at these resources, changing financial regulation. I think the big lesson here is we clearly need to massively to improve our ability to handle pandemics globally. That's one of the institutional changes we need. So the big point I'm making here is it seems to me that the community of nations, which means obviously predominantly the wealthy nations, have not responded in the effective, unified, coordinated way that was appropriate to this huge crisis. And worse, of course, there's been a very significant breakdown in relations between the US and China, and more broadly, the Western China. The US has pulled out of the World Health Organization. All this makes it much more difficult to handle what is, as we've been discussing, a global crisis, and inevitably emerging and developing countries which have the least domestic policy room for maneuver will be the most damaged.
Yes, and usually factors that are exogenous, like this is an exogenous factor, it's hit the whole world. Usually you want that brings people together, nations together, because you're fighting against one shock, it's not against nations, right? So I think there has been some initiatives, as I mentioned, the SSI, which is limited, but still does provide an important relief and fiscal space for quite a number of countries that have been participating in it. You mentioned the fund and the bank both have stepped up and put together programs, as well as other MDBs. We have been working very closely with them. The private sector has been, of course, it's more difficult for them to engage in such initiatives, but yet there could have been much more innovative ways of engaging in this effort. So any thoughts on that? Any more thoughts? You mentioned the SDRM, but any other ways, innovative ways for the private sector? Because at the end of the day, I think collectively, it's in the interest of the private sector to provide support.
I mean, one of the reasons I became convinced of when Anne Kruger proposed this in the early 2000s, and we strongly support it, that we needed an SDRM, which of course followed very shortly after the Argentine default in the early 2000s, was exactly what we're seeing now, the transformation of the universe of private sector lenders. So if you go back to, I just talked about the Latin American debt crisis is a very good example. In that first period, the very first private sector lending in a big way to emerging countries, it was from banks, and a relatively small number of banks. So when Paul Volcker and the US Treasury essentially decided this is what was going to happen, it wasn't terribly difficult to push all the relevant lenders into one room. There were a very small number of global banks, basically European banks and American banks, and they could, though they didn't, I think, do a superb job, they could coordinate them. And even in the Asian financial crisis, when push came to shove, it was still possible, notably in the case of South Korea, to for the American government basically to get their arms around the creditors and say, this is what's going to happen. But it became absolutely obvious after that that this couldn't happen again, because we've now got so many creditors with so many different characteristics, different fiduciary responsibilities, that, I was just discussing this with the fund, and I'm sure you know this, that in Argentina, for example, now there are actually 3 creditor groups, because the creditor groups are different in what they're interested in. Now, this becomes like really herding cats, and and I don't know, if we can't agree an international arrangement, I don't know of any alternative. But what I do think is very important is that if you have adequately funded IFIs, particularly the fund, it's most obvious its role, if it is decided there's a debt sustainability problem and the debt must be restructured or reconfigured, it must inform the lenders of that. And if the country makes a program which in good faith is justified by such a debt sustainability analysis, then the fund must be in the position to and be willing to lend into arrears on whatever scale is required. And that means obviously a lot of resources for the fund. And of course, the bank may well be part of that. In other words, the private sector needs to understand if they don't cooperate, they're going to be pushed out. And in which case, they're not going to get the service. That will give them, I think, an incentive to cooperate. I would much rather a global regime, but in the absence of a global regime, given this sheer diversity of the private sector, apparent inability to bring them all together into a room to reach a conclusion, then it seems to me there's no alternative but to proceed on the assumption that countries will in fact not be able to meet their obligations. Because the truth is, this is a situation in which debt restructuring is necessary. We all agree it's necessary, and we must proceed on the assumption that that's what's going to happen.
Yeah, we have been working very closely with the IMF on many initiatives in terms of debt, both in terms of debt sustainability, but also debt transparency, which is a key objective as well. I think there is clearly a need to better understand the composition of creditors, which, as you said, have changed dramatically, and the types of contracts have changed drastically. The transparency has been much less, and when you have that, and when you have the potential for gambling for resurrection, you can get really bad outcomes. So I think it's very important to address this issue and make progress as much as possible, which is one of the key issues for us. So I think one issue that would be useful to discuss is the low interest rates, and then we can move to more like what is the future, what type of changes we expect in the future. Right now, we have very low interest rates for a long time. And we have discussed, you have written about it, the savings glut and the implications of that. So one comment we always get when we talk about debt issues is, oh, well, the interest rates are very low and they are going to remain very low. That has its own complications, right? Both in terms of the types of lending that goes on, whether that's growth enhancing or not, as well as the unequal distribution of income, which then comes back again as economic issues. So it would be really good to hear from you as to your thoughts about the savings glut, the low interest rates, and what that means going forward.
May I just add one small point to our previous discussion, which to some degree fits in. Ever since the Asian financial crisis, so this is now, 23 years ago or so, and actually in a book that I wrote before the one you mentioned called Fixing Global Finance, I basically argued, and this is not original, that if you can't borrow in your own currency, you probably shouldn't borrow at all. I mean, there are tremendous risks in foreign currency borrowing, particularly if that means borrowing, and it basically always does, within the foreign legal jurisdictions. Because if you're operating under domestic law, you can adjust the debt. It's complicated, there are issues and risks, but if you're borrowing in foreign currency in New York or London or similar places, basically in a crisis, you're at the mercy of these legal systems and these transactions. And though I understand that it is tempting for many developing countries and emerging and developing countries to borrow when it's cheap, which comes back to your interest rate point, there are tremendous risks attendant upon currency mismatches within your financial system and your corporate sector. So my general view has been, as I said, you should borrow in domestic currency. Now, and a lot of countries have done that. That, of course, also create risk. We've seen there are exchange rate risks associated with it. But I believe that it is actually in the world we live in, being pretty self-sufficient in funding of development, except for very long-term borrowing from, for instance, the international development banks, is wise. The risks involved in very large-scale foreign currency borrowing are very high, and I've always thought that those emerging and developing countries that avoid this are wise. And I know they do this because savings are very low. Well, if savings are very low domestic, you've got to raise them. Now, these have been a particular issue in Latin America. I mean, I feel many emerging countries in Latin America haven't been developing their saving capacity adequately. Brazil is a striking example. So I just wanted to put that to one side. And then that links with the general world conditions. Of course, one of the reasons borrowing in foreign currency has been so attractive is that there is this savings, like whatever you call it. Real interest rates have fallen a long way on safe assets. And of course, there's a reach for yield in developed country markets as a result. So there's a tremendous flood of money looking for higher yield from the developed countries, or intermediated through the developed countries. The money pours into emerging and developing countries in good times, as it has, and then you've got this huge debt crisis afterwards, and all that was quite predictable. And I find it very, very depressing. I don't know what can be done about it, that this happens again and again and again. Now, fortunately, in this occasion, though it's not perfect, the Fed's actions have been so dramatic that they have to some extent calmed this tempest. But it remains a big risk. And of course, while the Fed has swap lines, it doesn't have swap lines with every emerging country by any means. So a lot of them are going to be dollar short. If they're not now, they will be soon. And I expect over the next 2, 3, 4 years, a lot of default. I may be wrong, but I expect a lot of default. Now, you then asked what might be called the $64,000 question. I was recently in an exchange on this very issue with Larry Summers, who was, after all, the secular stagnation person. It seems to me that what we would need to do to raise real interest rates permanently is to bring about really quite fundamental structural transformations in the world, which basically means China and the developed countries together in the balance between savings and investment. These are income distribution questions. Also in China, where household incomes are very low share of GDP, corporate and incomes are very high. This generates this staggering savings rate, which I don't think can be invested efficiently in China. It's one of their problems. In the developed countries, the problem is corporate profits are generally very high. That accrues to relatively well-off people. Income distribution of workers has shifted to the top. These are very high-saving people. And demand is relatively weak, partly because of aging. Because demand has been structurally rather weak, investment has been very weak. That's also affected by the way corporate finance is working, the role of so-called financialization. So we've got a set of structural factors that are generating structurally low real interest rates. Now, what is depressing here is that in theory, we ought to be able to find a way to use these excess savings in emerging and developing countries for long-term investment, because those are the countries with the opportunities. But we seem to be unable to do this. It's gone on for 20, 30 years. I've been worried about it. We've got this glut of savings. We could try to eliminate it at source. We find this very difficult. But the alternative is to use it to support the livelihoods of the people who are not so rich. But every time we do this, we end up with a massive crisis. And I think that's a profound failure. And it is worth remembering that these were the issues that worried people in Bretton Woods. And it was why the World Bank was created, to take some of these risks. I sometimes think we actually need to make international guarantee systems of various kinds much, much bigger than they are. So a bit more of the risk is, as it were, socialized, not all of it. And that starts meaning that the developing countries can start running, contrary to what I said, can start running large current account deficits more safely to fund investment, not consumption. But unfortunately, we seem absolutely unable to do this. But if we could come out of this crisis with a better capital intermediation system for the world, which involves a lot of reforms, that will be a tremendous improvement.
No, fully agreed. And I think this comes to one of the issues I wanted to discuss. We have been, at the bank, we have been discussing what we call jobs and economic transformation. And it's exactly the types of investments that are growth enhancing. Because if you look at debt and the accumulation of debt, that doesn't necessarily translate into growth. In many times, as you said, and the key is the need for more inclusive and sustainable growth that would generate, better jobs for more people. And this is what we have been really very much focusing on, especially, Ida, you have worked at the bank, you follow very closely. We have about $50 billion over the next 15 months that we will allocate on grant and highly concessional terms to the IDA countries. And the objective is really help them to get over the crisis, but also looking longer term. How can they build better? How can they recover better? And I think here it's really critical to think about the types of investments. And we talked about Marshall Plan at the beginning, or the European reconstruction effort after COVID-19. For many of the developing economies too, it's very much needed. We talk about technology. The digital divide is going to not allow some of these countries to really make use of these revolutionary changes. And if you look at it, when we dig deeper as we think about how we can have this economic transformation, a lot of it is the connectivity to markets, connectivity to finance, which may be one silver lining, and this is my question to you, is the incredible acceleration of the technological progress and especially digital progress. And there the question is, how do we use that to increase the much needed productivity in developing economies, like you said, for these profound changes in investments that can really help these countries grow going forward?
I think this is a fascinating question, and I wouldn't even pretend to know the answers. I'm sure you know far more about this than I do. I've been thinking a lot about this. Well, first we've had what's sometimes called the productivity puzzle, which is globally. So obviously now I mostly focus on developed countries, but it's relevant to developing countries. We are in the middle of what seems a very important technological revolution. But to paraphrase the famous remarks of Robert Solow about computers, we see computers everywhere except in the productivity statistics. And he said this, I think, in 1987. Well, we can say in the same way, we can see the digital revolution everywhere except in the productivity statistics. So somehow there seems, and I don't have time to go into a disjunction, and I think we can understand it, between the obvious fact of a technological revolution and the apparent failure to grow faster in most parts of the world as a result. The second point I've been thinking about a lot is, what do these new technologies mean for emerging and developing countries? And it seems to me at the moment that they look double-edged sword. There's a nice, there's one edge which is great and another edge which looks scary. I mean, the edge that looks scary is, well, a lot of developing countries grew through labor-intensive exports, labor-intensive manufactures. Well, if these all can be roboticized, that comparative advantage disappears. That's a very big deal. It's basically what drove Southeast Asia and East Asia. So that's a big question. Then, at the same time, so that's a downside. It's of course possible more broadly in developing countries that if you apply these technologies, it will mean a lot of jobs will disappear. If you think about a country I happen to know relatively well, India, because I've worked on it and I've followed, an enormous number of jobs are in retail, in really quite, by global standards, inefficient retail. You then have the Amazons and their likes, the Alibabas, all coming along. This could just transform the whole retail sector, and it will be job displacing, massively job displacing. So this is one edge. One edge is a tremendous challenge. The other side, of course, is there are also opportunities, because there are things that are done in developed countries which people in developing countries can do if they can be part of a network like this. We have, to take an example at the Financial Times, we have gone completely online in our production across the world. Well, there's no reason in principle for businesses like ours why some of the people we employ shouldn't be. In fact, we already do employ a lot of people actively part of our system in the Philippines, for example. So that is an opportunity, a really big opportunity. But that depends, of course, as you said, on the quality of the internet connections, the solidity of communications and other infrastructure. But it is also clear, and this is the final point, because you can see this happening, there are a lot of countries that have been able to use new technologies to leapfrog. Banking, for example, is a very important example. It has been possible essentially to bank everywhere in a country and to provide telephones for everybody in a country, even before that, because of technology. So I see there being huge opportunities here for countries that are really determined to take advantage of it, and China is obviously a great example. But there are also some very big threats, and I don't think anybody can opt out. They're there, but I think the management in the development context of the new technologies is going to be a tremendous challenge, social challenge and economic challenge.
Yes, and we actually see this very clearly in the use of digital financial services.
Yes.
And it is going around the vested interests, which are your usual commercial banks, which are either very conservative or finance related vested interests. So, digital services with the ability to, without collateral, to track transactions, inventories, and so on, has been able to reach even microcredit to
yes, absolutely
excluded. So I think digital financial services has enormous potential, and we have seen this already. We also see a lot of potential for what we call GovTech, which is transparency in public service delivery. This crisis, if anything, I think really highlight the importance of effective and efficient public administration and public service delivery, and making that much more transparent and accountable with anything from e-procurement to clear, transparent services that are targeted to the right people is very critical. So this has been a lot of our effort, especially with the social safety nets that we have been working on. But there is a concern that some countries which don't have those connectivity, it depends also on access to electricity, right? So this has been a key component of our work in terms of rebuilding better. We have, and I think you have seen it, we have recently, just last week, came up with a book on productivity, looking at the developments and emerging market countries, really studying the trends, and for many of them, they are suffering serious slowdowns. And of course, the policies will have to be adapted. There are many challenges, but I think this is an area where there are potential, where there's huge potential for the right type of transformation and really productivity. I wanted to ask you about, I mentioned energy, and that of course always triggers sustainability, which is an issue that we really need to think hard as to how we going forward as the future, a future which really helps us in terms of, you know, as mentioned, really addressing the gaps in terms of the technological gaps, the equality gaps, but also sustainability. So there's a large effort, I think, to rebuild in a green way. So it would be good to hear your views. Of course, for the World Bank, this is a key priority, and we work with many countries as to how to have a much more green recovery. But it would be great to hear also from you as to how you see things and how you see the role of the bank.
Well, first of all, I followed the climate debate fairly closely for about 15, 20 years. I focus predominantly on issues in developed countries and one or two big emerging economies, particularly China. But it does seem to me that actually developing and emerging countries have quite an opportunity in the new energy, in the, if you like, the renewable energy revolution. There are obviously some very technically challenging aspects to this in creating functioning, integrating grids, or if not integrated grids, distributed systems that are reliable. Clearly everybody understands these, but at least many emerging and developing countries have very good natural resources, as it were, in this area. They have, by no means all, but they have lots of sun on the whole. And so solar energy is relatively effective. And some of them have a lot of coastline, although, of course, many don't. So that should allow offshore wind, which has been working unbelievably well in Britain. So I presume it would be also possible in many emerging and developing countries. So, and they don't have an old established infrastructure on the whole, so they can leapfrog again, as they did with telephony. I mean, essentially, the mobile phone allowed many countries to jump into universal or near universal connection, which would never have happened in the old technology. And I think the same applies here. The difficulty, of course, is organizing these systems in a way that is effective across countries. I do think one will need grid integration to some substantial degree. That's obviously technically very difficult. But I do hope that we can use this opportunity of this crisis to build back better, as people say. And this is one of the best opportunities in terms of investment. And the final element of this, which I think to some degree is going to happen anyway, is of course very important that they have access to the best available technology, which is now fairly widely distributed around the world. In the end, if climate change is to be managed, the economies which are going to see most of the growth in the next 40 years, which will clearly all be emerging and developing countries, there's no doubt about that. That's where the incremental energy demand is going to come. So if they go coal or fossil fuels dependent, then it's over, The game is over. So it is unbelievably important that there be and this is again part of what I'm saying is a higher level of global cooperation which lasts beyond the crisis to meet these challenges. And it's evident that the challenge of global cooperation at the scale needed to shift fossil fuels emissions over the next decade, there has to be a dramatic change, has simply not happened. And it will only happen with enormous global effort, which the world as a whole is committed to. And unfortunately, right at the moment, that's not where we are.
It's where we would like to go. And
it's where we would like to be. Yes.
Yeah, this is, we are running out of time. So I would like to ask you there, where do you see the silver lining? What are the positives? So that we end on an optimistic note.
I find this very difficult. Well, the crises, if you look back at history, crises have two possible consequences, and you can see it very clearly. In quite a number of cases, societies break apart old systems. Crises nearly always break apart old systems, and I'm assuming this one is doing so. It's pretty clear it is. And they disintegrate, and people can't work out a way of improving them. And that, I think, is the best way of thinking about what happened in the 1920s and 1930s. The old world was destroyed, but the new world couldn't emerge. And the old world needed to be destroyed. It was a bad old world. So I had no problem with that. But it took, in the end, basically 40 years to do what should have taken 5 or 10. I mean, they should have been dismantling all the empires then already, for it to take one example. Or preparing for that. And the reason is that the crisis exacerbated differences among nations. It didn't bring them together. And sometimes crises force people to act together. I would say the oil crisis was so-so, but actually I think in a strange way, the response to the financial crisis, which should never have happened, was actually quite impressive. The immediate response was quite impressive, partly because China's remarkable growth. Developing countries didn't do too badly. As I said, there was a big effort to improve resources, a massive effort, which I was personally a little bit involved in, to regulate the financial sector, make it stronger, and it was made much stronger. So that was we use it so-so. Now, right at the moment, I think we're at the stage in history where this crisis will either really break up the old world and leave us with the most terrible chaos, global chaos, or it will force people to start cooperating seriously again. I think for the latter to happen, some pretty big changes in politics have to occur, particularly in the developed countries, but also in emerging countries. I think we've been flirting much too much with the idea that we don't need competent government, we don't need professional government. I can say these things, you probably can't. That we can do without effective international cooperation, even when we differ very strongly with other countries. So at the moment, I would say we are on the cusp. It's not yet decided. There's going to be some important moments, elections and so forth are going to happen. I am particularly worried, it has to be said, about the relations, as I discussed at the beginning, between China and the West, which are, I think, really on a knife edge. But it's important to remember, crises are an opportunity to do things differently. There are a lot of areas where we need to do things differently. We've been warned, inequality is too high in our countries. We're being badly governed in the developed world. A lot of emerging and above all developing countries have sort of lost their way on productivity for a long time. We need this massive climate revolution. We need a massive upgrade of global health systems. will we get leaders who see that urgency, policymakers who see that urgency? I think at this stage we can only say it's not clear, but there is an opportunity here for sure.
I agree about the opportunity, and we will all keep on working on the opportunity. Hopefully, we will learn the lessons from the history and make sure that we don't repeat them. And as you said, I think I was also quite engaged in the 2008 crisis, and one of the big lessons was, going from microprudential to macroprudential, that, individual is not going to get the collective.
Huge lesson we learned.
Exactly, and we need to use it in this crisis. And for sure, at the bank, what we have been concentrating on is rebuilding better, which includes the elements you mentioned. So we're for sure pushing on our mandate, our agenda, and hopefully there will be even more global collaboration going forward. Thank you very, very much. This has been an excellent discussion. I wish we had more time. It's always great to read your columns, listen to you, and I really very much enjoyed this, and I'm sure our listeners have also appreciated it. It will be online if anyone wants to listen to it and respond. We can also respond to some of the issues that came up. I weaved in a lot of the questions as we went along, but if there are others, we can come back. So thank you so much, Martin. Great to talk to you.
It was an enormous pleasure, honor and a pleasure. Enjoyed it very much, and best of luck with your important work.
Thank you. Bye-bye.
Bye.
Bye-bye, everyone. Thank you.